Folks, did you know that the 2-year Treasury yield posts biggest 3-day decline since the aftermath of the 1987 stock market? If you don't remember what happened in 1987, it is often called Black Monday. It was a ugly and painful day. And to say that we have the 2-year decline, the biggest since then, that is not generally a warm and fuzzy feeling. In order to have this conversation, I brought on the man, myth, the legend, Taylor from Life Goal Investments. How you doing, man?
Let's do this. You're talking about a 3-day movement that's larger than after the day when the stock market lost 22% in one day.
Yeah, Black Monday, 22%. That is why we have circuit breakers. That day, all by itself.
It changed the entire system of the market based on that day. Yet we just saw a bigger movement in bonds over the past 3 days than we did back then.
Yeah, we will never see a 22% decline in the stock market ever again because of the circuit breakers.
Correct. Yep, absolutely right. But we had a circuit breaker, if you would, in the banking system that caused this huge unravel in bond prices over the past 3 days. It's been monumental, and it's been across the curve. So the shorter end, which is more dependent upon the Fed, has seen a larger movement downwards. So the 2-year came from above 5. I'm sorry, I think it was at 507 to down to right about 4%. So that's
100 basis points.
100 bips, and the 10 years down from 4-ish% to 3.5%, somewhere in that ballpark. So that's 50 basis points. So the front end has moved more, but the back end has moved meaningfully as well. It's been a systematic repricing lower on yields, driving bond prices meaningfully higher.
Yeah. So this is why you're on the channel, because we got to really break this down for the average person. So if we rewind the clock to like 6 weeks ago, bonds, the 10-year was really stuck at 3.5 for like 5 weeks. It was like you could just see it stuck there.
Correct.
And we actually saw mortgage rates, which is obviously plays a big deal in what I talk about every day, ticked all the way down to 5.99. And I'm like, this is a problem. Real estate's going to go bananas. Demand's going to go up. And sure enough, it did. Now, very quickly, 10-year unanchors from 3.5, gets over 4. Mortgage rates go from sub 6 to over 7. Stuff slows down. Then we get Jerome Powell on Wednesday. Actually, I think it was his Tuesday discussion, where I say he came out and was Jackson Hole, mini Jackson Hole or Jackson Hole 2.0. He basically, we're going higher, faster, longer, all bad.
Yep.
Stuff reprices. BlackRock comes out, says Fed's going to 6 terminal rate.
Yep.
Some people are saying that won't be enough. They got to go 6.5. Mortgage rates go up. Then lo and behold, we have Thursday. Then we have Friday. Now we have Monday.
Don't forget Sunday too. Sunday was important along the way as well.
Sunday, bond market's not open, but Sunday, Sunday.
We were weekend warriors this weekend.
Oh yeah, everybody was. I mean, I was following. And then now we're back sub 3.5 on the 10-year. Last time I checked, 3.46. 2 years down. So mortgage rates are down. Now I think we're gonna have mortgage rates sub 6.5. And given the fear in the system, it would not shock me if mortgage rates are sub 6% in the next 10 days. What do you think of all that? Do I have that all right?
I think you're spot on across the comments there. So when you think about the yield curve, so like from an investment standpoint, the yield curve is the shape of so shorter end rates are more dependent upon the Fed. So call it inside of 2 years, the Treasury yields are dependent upon the Fed. If the Fed looks like they're going to raise rates more quickly, they shoot up. If they act like they're going to be more dovish and not be as aggressive on that end, they're going to come down. The long end of the curve, on the other hand, is more dependent upon growth in the economy and inflation. And so that's what drives the long end of the curve. So throughout this year, I and Life Goal Investments in general has been really concerned with what was happening on the long end of the curve, because all of the data that was coming out was saying that whether you're looking at company earnings, whether you're looking at PMIs, manufacturers, whatever it is, was saying the economy's slowing, but the long end was pressing higher. And we're like, this doesn't make a ton of sense.
Doesn't make sense.
But the trend was driving the long end higher. And we're like, that's going to break. And that seemed to break, obviously, last week. And the front end came down as well. But the front end is dependent upon that Fed. And the back end is now, hey, what is going to happen with growth in this country? We just saw meaningful cracks start to form. does that come down further? And I think the long end is going to continue to have pressure pushing down yields here for some time. And
Yeah,
to
and
your
again,
point, that also
yeah.
takes down your mortgage rates, which
Yep.
creates a feedback loop in the real estate
Yeah.
space.
One of the things that I think is going on, and actually I still haven't checked the price of gold. I made a call on gold. I'm going to look right now this morning. Oh, it's up. Good. Because I called that this morning. I'm like,
Yep.
two things happen when there's fear. Bonds, rates go down, and gold goes up. I'm glad I called that. So yeah, it's up $48. I'd say I was right.
Yep. We talked last week. And so we've put out several messages this year. Like my firm and myself has been very concerned about what's going up or what's going on. Like stocks are going up in the face of bad news across the board. You're getting bad inflationary news. You're getting bad economic news. Now you're seeing bad things play out in the regional bank sector, and you're having bonds rally again today, or I'm sorry, stocks rally again today. And it's like, this does not add up. So we've been talking to people till we're blue in the face about diversification. We've been telling people bonds and gold. And obviously both of those are catching a massive bid today. And I think they probably continue to moving forward because I don't think this gets better anytime quickly, honestly. And I feel bad because I talk about this stuff and people are like, you're a negative Nancy. And I'm like, I'm not always negative. I'm actually an optimist. That's my trait. But I got to be a realist and tell you what we're seeing in the market right now. And stocks trading up today does not make sense to me.
Yeah. The reason I chuckled is I was, I pulled out my phone for the first time because I've been doing interviews all morning. I haven't checked. Would it shock you that Bitcoin is up 15% today?
Oh, absolutely. So I knew Bitcoin was up big. I didn't realize it was up that big. But
$3,000, $3,100.
This is that whole, hey, we're going to come off of the dollar system, the fiat currency, et cetera.
This is why the Fed has to raise next week. You can't. This is risk on. The Fed's going to bail everybody out. There's no pain ever. We're all good. This is why the Fed or the Treasury or FDIC made a mistake. They should have. Again, if Silicon Valley Bank would have unraveled and everybody was money good, you give them 85 cents now and you give them 15 cents later. That's what I was
love
hoping
that.
for.
I had not thought of that myself, but I love that theory because that is like, listen, guys, there's risk in the market that you're taking. Understand the risk you're taking and be a big boy about it and girl about it and take the risk that you're taking. You might have some losses.
But we've capped your risk, right? We got the rest.
Yep.
If the balance sheet is total garbage. Because again, deposits, you don't want to trend, but this is not what Powell's looking at. Bitcoin up 15% today going, shit.
Yeah. I can't imagine what some of these Discord groups are talking about with Bitcoin right now with guys, look at, we've been talking about this, the fiat currency.
You got to own it because the banks are going down. Yeah. The dollar's going away. It's not the reserve currency of the world.
Exactly.
Well, I have I have a little more than one coin. I bought it as insurance years ago, which I'll just keep in my, whatever you call it, wallet or whatever they call that thing. But yeah, that's shock. That's why I chuckled because I did not expect Bitcoin to be up. I expected it to be up, but not 15%.
Yeah, correct. Yeah. Because you think about Bitcoin last year and it was the inflationary hedge, quote unquote, and it got smoked in the inflationary market. So it was like, anyway.
Yeah. So, the thing for me is, let's talk about bonds. You obviously have a couple of products. I think it's very well worthwhile because again, you got to be diversified in all of this. Which one of they also have commodity exposure? You and I have talked about this off air. And again, having exposure to gold, silver in an environment like this, plus bonds with some stocks is kind of an interesting play. Why don't you remind folks what you provide at Life Goal Investments? Because I think it's something they might want to look at.
Yeah, thanks for the opportunity to do so. So there's really two ETFs that we bring to market that are vastly or widely applicable to most. The first one is called SAVN, is the ticker, SAVN, the Life Goal Conservative Wealth Builder. And so for people that are looking for diversification and bond exposure, that portfolio has to be at all times at least 75% bonds.
Oh, wow.
And so that is something that you can always hang your hat on to say, I know this is a conservative portfolio. It can't own more than anything. Now,
just because I hold myself accountable to ask questions. So you say 75% bonds. I'm going to guess that's treasuries and corporates.
So it is more broad than that. So we can own emerging market debt, high yield, et cetera. But this thing is built to be that kind of all-weather tire.
So you could get worldwide exposure.
Yeah, you do get worldwide exposure inside of it. And you do get some commodity exposure. The bulk of the commodity exposure is in gold. About 75% of the commodity exposure is in gold inside the portfolio right now. So with that, you're obviously catching a bid here. This is, in my opinion, one of the best ways to play a downward trending market, because you have a little bit of stock exposure in case you do bounce off the bottom of a recession. But on the other hand, you're the vast majority of it sitting in bonds that are going to hold up well in a portfolio like this in tough times. So like this portfolio, since it was incepted in September of 2021, has outperformed the S&P, the MSCI World, the global stock index, and the Barclays Ag, the bond index. So it's outperformed all three of them, and it's an easy one way to diversify, broad exposure, stocks, bonds, commodities, real estate, all in one with a heavy exposure to bonds. And then it has,
so you got 75%. What's the other one?
And that's also the fee on it's 0.34%. So 34 basis points. So the fee, we actually took it down. It's very, very competitive. And the other one to look at is Wealth Builder. And that's just ticker WLTH, wealth without the vowels. That is the more aggressive of the two. It still has all the exposure to stocks, bonds, commodities, real estate, but it has significantly higher stock exposure. It's about 60% right now inside stocks. So with that, if you're looking for a single ticker symbol to take care of everything and you're a long-term investor, wealth is a better option. If you're looking to diversify a heavy equity allocation, saving is a better option because it's heavier allocation to bonds.
Very cool, folks. Well, where would people go find more about this and follow you? Because you put out a lot of daily stuff now,
Yep. So lots of information on our website. That's lifegoalinvestments.com. And then our daily market economic commentary, whatever it may be, is on TikTok and Instagram. That's not product oriented. That's just general markets. And we're at Life Goal Investments there.
Thank you, buddy.